is that at the end of every year, businesses have to prepare reports. We know that these reports are known as financial statements. Now, at the end of the accounting period, sometimes there's the need for there's the need for adjustments to these financial statements. Okay, so today we'll look at some required adjustments, particularly accruals and prepayments. We have heard this. Last week, we talked about revenue and capital expenditure income. And so from these revenue, expenditure, and income, we have accruals and prepayments. Then we also have some possible adjustments known as bad and doubtful debts at the end of the accounting period. At the end of the session, we should be able to distinguish between bad and doubtful debts, learn how to provide for doubtful debts, pass the entries to record them, and make adjustments to prepaid, accrued expense, and revenue. Okay, our text reference, we have them. In accounting, a couple of weeks ago, we talked about control accounts. We know that control accounts captures a summary of all transactions related to the sales ledger or the purchases ledger and other transactions that would find. Okay, but more importantly, control accounts refer to the account, sales ledger control accounts, that picks the summary of the trade debts, okay? And trade debts will always arise from the sale of goods or service on credit. So control account normally picks the credit information, the credit sales. Now, that credit sales refers to customers we have sold to, but are yet to pay us. Now, the question is, the value of that credit sales will be realistic to show on our financials. We need to know the true state of those, okay, customers' affairs as at the end of the accounting period in order to be able to match, okay, the results from past sales. It is very important to know the true value of those trade debts to avoid possible loss, unexpected losses in the future. Okay, and so we need to determine out of those credit sales, which customers are paying on time, which people are delaying payment. Now, the process of doing this is known as aging, the aging process. And the aging process looks at how long customers are paying back their debts. Okay. Of course, sometimes the business is a cash discount. We've already talked about that. But once that we made in our books, we have to always, and at regular intervals, assess how well the debt is being paid. And that is the aging process, okay? It's just an assessment of how long the debts have been in the books of the business, okay? With the mindset of making sure that we try to recover it, or if that is not possible, then we take the necessary steps, okay? And so as the debts become very old in our records and circumstances make it impossible, it is prudent to write it off. Remember, accountants, per the prudence concept, are supposed to be quick, okay, in recognizing losses, but very slow in recognizing revenue. Okay, and so based on that, if we have a feeling that certain debts from certain customers, they are not paying, okay, sometimes it's out of experience. You have a customer who is paying, who pays on time regularly, and then all of a sudden, that customer starts defaulting. That customer, okay, starts failing on its payment. The obvious thing, of course, is for companies to make some inquiries. Okay? If the inquiries suggest that it is not possible, we have to write it off. And that amount written off totally is known as bad debt. Let me draw your attention to control accounts. One of the transactions that reduces the amount of credit sales, okay, and which is credited to the control account is bad debts. Because when we say the debt is bad, it means that the possibility of recovery is virtually 0 than 1. And so we have no option but to fall in line with the prudence concept to quickly take it off our books and treat it as an expense, okay? And that is bad debt. Now, again, bad debts could arise because collection has become uncertain. So there are two issues here. The first one is where it's completely impossible, either because the company may have gone bankrupt, they have folded up, something has happened. So, for instance, COVID, some companies will definitely fold up. Some have already folded up. So if such a company or business or a customer is your customer, you have no option because the company has folded up. On the other hand, there is also a situation where collection may become uncertain. So in the first instance, it is virtually impossible. In this instance, there is a level of uncertainty, okay? And again, erring on the side of prudence, we are supposed to provide for that uncertainty, okay? And that is known as the provision for doubtful debt. I've already indicated that anytime you see a provision, they are just sums set aside for unforeseen circumstances. And so provision for doubtful debt is because the debt that is standing there against a customer's name or a number of customers seems impossible, okay, or there is some level of uncertainty. And so because of the level of uncertainty, the business wants to set aside some amount just in case later they are unable to pay. And that is the provision for doubtful debt. And so take note of the two. You would again recall that in the control accounts, we were not capturing provision for doubtful debt. Why? Because that does not reduce the debtor's figure or the credit sales. It is just a sum set aside. But with bad debts, we have completely written it off in our books. And so it reduces the amount or the value of the credit sales. And that is why in control accounts, we record bad debts, but not the provision, okay? Now, with respect to bad debts, these are the accounting entries. Let us also be mindful again that bad debts are debts that have become uncollectible, and hence it is a loss to the business. And once it is a loss, we have to write it off the books totally. And so these are the bookkeeping entries. We note that when we sold to the customer, what entries do we pass when we sell to the customer? What is the double entry? Who can help us out? When we sell to a customer, what are the double entries? Millicent Trinebois. Millicent Trinebois, Enim. Yes. Deborah, I'll pay. Deborah, when we sell to a customer, what are the accounting entries?
Madam, you credit the inventory account and you debit either cash or bank.
Hey, I didn't say cash sales. So.
Okay. For credit sales, you credit the inventory account, then you debit the receivables account.
Okay, so you debit, and my interest is more in the debit of the trade receivable. Okay, the customer account is debited. Okay, and sales or stock, wherever you have it, is credited. And so you recall that in our books, that customer's account, okay, is captured under trade receivables. We expect to receive, it is on credit, so we expect to receive. And so if after making all the efforts, we are unable to collect, we take it off, and that is bad debt. So we debit the bad debt account and credit the receivables with the amount outstanding. And so that shows that in our books, we have cleared off account. Okay. At the end of the accounting period or at the end of the year, at the end of the accounting period or at the end of the year, the bad debt account is credited and income statement is debited with the total amount of bad debts. Okay, so you realize that the bad debt account is only, maybe I should say, a suspense account, an account that holds the bad debts that's for the period which has accumulated, and then at the end of the year, we move the amount, the total amount, to the income statement. And once you see a debit to the income statement, it suggests that it is an expense. Okay, it is an expense. What about the doubtful debts? Let us recall that doubtful debts, okay, are just provisions. And so in providing for the doubtful debts, they could be specific or general. Now, specific provisions are just provisions made for a specific debt. So let us throw our minds back to the first day we had lecture, ascertain, where we sold to ascertain, assuming that we envisage that ascertain is having a challenge and may not be able to pay. Okay, we can open a provision purposely for ascertain's debt, and that will be the specific provision. Generally, okay, it is also a requirement that for all of them, because sometimes customers may leave a few pesos and pennies on their account. Okay, some may return, some customers may never return. Now, and so we also need to make general provisions. Okay, and this one, they may be general across board. So we just talk about a percentage, they set it aside. Anytime we sell, we make a general provision for the remaining debt after deducting the specific provision. Okay, after deducting the specific provision. How do we calculate provision? Okay, most often the rate is given and you may be required to calculate it on either the outstanding total receivables or on total credit sales. And so in any question, you have to look out for whether you are computing the provisions on the outstanding receivables or on total credit sales. And that is one thing we must take note of, okay? Because the provision is on credit sales. And so you must be looking out for credit sales or the outstanding total receivables. And so what are the accounting entries or the bookkeeping entries? Whether for specific or general provisions, we will always debit the income statement and credit the provision for doubtful debts. Okay, again, that is a suspense, or that is an amount set aside. And so, okay, now that is if the provision is the first time. So assuming UGBS JCR has sold exercise books to level 200 accounting, okay, and they envisage that in collecting the money, about 1% of the students will collect it and not yet pay. Or even the various departments would also collect it, but they may not be able to pay. Once that happens, okay, you need to debit the income statement because you are also setting the sum aside. So where would you pick it from? Definitely it is a charge against the profit. And so you would debit the income statement and credit the provision for doubtful debts. Again, this is for the first time a provision is being made. Okay. Now, when the provision has already been made and you are in the subsequent accounting period, so 2019, 2020, let's assume that 2019 December, we bought goods, made a general provision of 100 cedis. Then in 2020 April, our financial year end, what do we have to do? We will have to compare the current computed provision to the previous one. Just a minute, let me get water. Compare the current computed provision to the previous one. So I was using the example where we have computed till December and we are in April. It means that we have to compute for April ended, compare it to the 31st December provisions. And if the April one is higher, okay, than the December, then we say there is an increase in provisions. And anytime there is an increase, okay, we recognize only that amount, that difference. So the amount of the increase is what is charged to income statement. Jessica Dodu, behave yourself. Once we do that, the difference, okay, is what we put in the income statement as an increase. And then record the April figure as our new provisions amount. Let me take that again. Anytime you have to deduce the provision for subsequent periods, you will have to compare computed provision to the previous period end. The difference, if the current one is higher than the previous one, then we say there is an increase in provision. And the difference is what is charged to the income statement, because you would have recorded a current figure in your books. Okay, and so the difference you have to charge. Again, the previous amount would have already recognized it in your income statement. So it's just the difference. Now, when the current period amount is lower than the previous December 31st provisions, then you say there is a decrease in provision. And so that would decrease, the amount is a decrease and is credited to the income statement as a gain. Okay, so take note of that. Now, in all cases, the current provision for the year is used to reduce the value of trade receivables. Where would you find trade receivables? Simon Kise. Simon Kise. Simon, where will you find trade receivables? Trade receivables to reduce the value of trade receivables in the statement of financial position. Now, there are instances where you can recover the bad debts. So you recall that when somebody is making noise, when the debt becomes virtually impossible to collect, we write it off as bad. Now, there are instances that you can recover those bad debts. Okay, there are instances where you can recover them. It could be that you have taken legal action to recover. It could be that the customer has also gotten some money and wants to come back to re-establish business connection with you. Now, there are two instances, in the treatment of bad debts that have been recovered by the business. And it depends on whether the business wants to continue to do business with the customer. Now, if they want to do business, if they want to continue to do business, then they have to re-establish by opening the account of that receivable, that customer, couldn't pay or whose bad debt was written off. If there are a couple of them, then you just have to open the bad debt recovered account and the trade receivables account. So you will have to debit the trade receivables account. Now the intention is that you are bringing back the debt into the books. Remember, when we were writing it off as bad, we credited trade receivable to nullify that figure. So if we have to come back, we have to put the figure back and establish trade receivable by opening the trade receivable account and debiting it and crediting the bad debt recovered account, to reinstate the amount. Now, once that is done, because the value has been received, you would have to debit or bank the amount received, and then you debit the bad debts recovered and credit your income statement. Remember, because we wrote off the debt as an expense, this time we must credit our income statement as a gain or a profit to us, as an income to us. So of course, somebody will say that it didn't come in the period. It doesn't matter. If you wrote it off last year, it will be treated as income, in the financials, in the income statement, to increase your profit. And that is why income statement is credit. It's troublesome. You don't want to establish any further relationship with the customer, then you don't go and reopen the customer's account. You only receive the money, credit your bad debt road. You debit the bad debt recovered and credit your income statement. So the end result is that the entries are virtually the same. The only difference is that in the first instance, you want to continue a business relationship with the Any question? Okay, if there is no question, with another adjustment that we may find or come across when we are preparing the financials, let us note that all these things we are doing, from depreciation, bad debts, and these adjustments will have an impact on what we'll do on Thursday. So let's make sure that from here, we would all go through it. On Thursday, we will have a full-blown financial statement to prepare. Okay, now let's look at the next group, the adjustments for prepayments and accruals. Let's cast our minds back to revenue and revenue expenditure and income, revenue expense and income. Okay, a couple of weeks ago, we talked about that. Okay, and we suggested that revenue expense is expenditure that will incur within the calendar year or within the financial year, which is expected to be paid within. Of course, we acknowledge that sometimes it is not paid within the financial year and can be paid later, but of course, not too long. Whilst revenue income are amounts we expect to receive or have received, okay, within the financial year, okay, and relate to amounts that we expect to receive within the 12 months, okay? Now, one thing we must note is that expenses and revenue are not always paid or received on time, okay? Sometimes they are not. Cash paid and received in a year, okay, should also not be entered directly. Now, don't take this out of context to say that anytime we sell for cash, we should not enter it into the books. No. You recall that anytime we receive cash or pay cash, it goes through the cash account. We don't bring it directly into the profit and loss account. Okay, it goes through the double entry. And so there are periods that we need to make adjustments to this, either because the amount we have received or the amount we have paid, okay, does not reflect the true amount that we should have received or the true amount that we should have paid. And so we need to adjust to show the true reflection of our expenditure, okay, or our income for the period. So we'll take them one after the other. The first one is prepaid expense. We have accrued expense. We have prepaid income, and we have accrued income. Now, what is a prepayment? Anytime you hear the word prepayment, it suggests payment in advance of the consumption of a service, okay? Again, take yourself as the business entity. So this is an expense. You have paid for that expense in advance. What are some of the expenses we can pay for in advance? Today, practically, who can give us one expense that we normally would pay for in advance? Yes, Deborah.
Madam, rent.
Rent. Rent is something we paid for in advance, and most of you students would have paid your rent in advance. Okay, I saw Samuel's hand up. Samuel, any other example?
Madam.
Okay, Princess.
Madam, school
yes,
fees.
Princess.
School fees.
School fees. Okay,
Yes.
so if you were all businesses, your school fees that you have paid for the year, okay, yes, it's an expense you have to incur, but you have paid it in advance. And so anytime you hear the word prepaid.
Madam, hostel fees.
Hostel fees, good. Okay, it means that you have paid in advance. Okay, another name for prepayment is payment in advance. So you would see in other textbooks, payment in advance. Okay, now those are used in the following period, but have been paid for in advance. So hostel fees, for some of you may have paid for the year. You would only use the hostels after another 12 weeks when you return, but you have paid for in advance because you want to secure the room. Okay, and so that is a prepaid expense. If you, okay, as I think it was Kwesi who said hostel fee. If you, Kwesi, was a business entity, then the hostel fee you have paid is a prepaid expense. Okay, meaning that you have paid in advance of the usage. Then we have accrued expense. Okay, accrued expense refers to expenses you have used, you have incurred, but you are yet to pay for. So who can give us an example of something expenditure that you have utilized, but you are yet to pay for? I saw a lot of hands up then. Eric. Yes, Rebecca. Rebecca. Water bills. Good. Water bills. Okay. I can see another hand up.
Madam,
okay,
electricity bills.
Are you sure? Rasmus, your electricity bill, how do you pay them? Are you on postpaid?
Madam, some of them are prepaid. Madam, some of them are postpaid and others are prepaid.
Okay, so clarify it. Okay, so if you know that some are
postpaid,
some are prepaid. So if you are enjoying postpaid, meaning that you use it before you pay. Okay.
Yes, please.
But a very practical one for most organizations is water. Okay. The water. Now, why are we interested?
Okay.
Of the expenditure for the period. We are not interested in higher or lower values. How much really did we incur as expense in the period we are preparing the financials? And that is the reason why we need to take care of all the prepaid and accrued. And so if we have a prepaid expense, which period should it be reflected? Yes, Teresa, what is it?
Madam, please. And when you said the examples of accrued expenses, and loan came in mind, answer to ask if a loan is an accrued expense.
You were asking if what?
Loan. When you're going to take a loan, is it an example of accrued expenses?
Loan, Teresa.
Yes.
Is it an expense? Is loan an expense?
Madam,
That is what is an expense? What is an expense?
Madam,
yes,
I know
what is an expense?
An expense will cause a decrease in the economic benefit.
So you don't know an expense, okay? And that's why you're asking, because by now you should know where loan is. need to recognize expenses that relate to the period for which we are preparing the financials. Okay, amounts that we should have paid for this period. Let us recall matching concept. So if you have water bill that is outstanding or that is accrued, another name for accruals is always outstanding. Okay, how much will we record for the period? Whatever is outstanding, you have consumed. And so it should reflect in this period account because of the matching concept. And that is why we need to identify the prepaid expense and the accrued expense. Now with prepaid income, these are income that those to be earned in the following period, but have been received in advance. So a customer, okay, has brought you some money. The goods are not yet ready, okay, and yet you have received that amount and are yet to provide the service or the goods. And that would be a prepaid income. The income or the revenue has been paid in advance. Okay, and an accrued income would have been earned but have not yet been received. So an instance will be when you sell to customers on credit, that will be accrued income. Okay, now when it is a prepaid expense, where would you find it? Where will you find that value that has been prepaid? Is it an asset or a liability?
It's an asset, please.
An asset.
Asset.
You have paid, but you are yet to enjoy the service. Accrued expense, is it an asset or a liability?
A liability.
Liability.
Why is it a liability?
Because you have enjoyed it, but you've not paid for it.
Exactly, you have enjoyed the service, but you are yet to pay for it. And so you must recognize it in your books as part of your expense for the period. Prepaid income.
This is a liability.
Why
A
is it
liability.
a liability?
Because you've received money for which you've not delivered the goods or you've not performed the services, please.
Okay, so you have received money that belongs to third parties until you provide that service, okay, or you provide those goods. So for instance, okay, if your income that you have paid to the University of Ghana or to the hostels, in the books of the hostels, they are prepaid incomes. It's money belonging to students. They have not yet provided a service. So to them, that money is a liability. It belongs to third parties who are students. Okay. And accrued income, is it an asset or a liability?
An asset, please.
It is an asset because you have earned, you have provided your service or the product, but you are yet to receive the amount of money. Okay. You are yet to receive the amount of money. So now let's look at this one. Somebody to read for us.
Expense example. 2 companies paying rent to a landlord in Accra. The rent is 3,000 Ghana cedis a year. Company A pays 2,500 in the year. Company B pays 3,100 in the year. How much rent should be charged to the income statement for the year in each company?
Okay, so who will try the first one? The question is, how much rent should be charged to the income statement for the year in the company's books? expense. Who would take that for us? Renee Ellis. Renee. Okay, Saki Forson. Yes, for Saki.
Hello, madam.
Yes.
Madam, please, 3,000 will be charged to the income statement for the first company. So that is, you add 500 to the 2,500.
Okay, so Forson says 3,000 cedis will be charged as rent in the income statement of company A. Do we agree? Who thinks otherwise? So that is the amount of rent that we have incurred, the amount of rent we have to pay. But look at it, company A has only paid 2.5 for the whole year. So maybe they were paying in bits and they've paid, the year has ended. They've only paid 2.5. Pakwesi Ando, what is it? Pakwesi? Yes, Pakwesi. Okay, so indeed, in our income statement, we recognize 3,000 as the rent for the year. But the actual cash we have received, or the actual cash that has been paid by company A, is 2.5. So what is the 500? Which of the 4 identified ones? Yes, Saki.
And please, the 500 is owings or accruals.
Accruals what? What accruals?
Rent accrual.
Okay, so it is rent accrued, which is an expense, because company A is paying. So it is an expense. So it is accrued. It means that at the end of the year, company A has enjoyed the rent, the facility, but is yet to pay 500. Okay, and so in the income statement, we show 3,000. We have received, the 2.5 has been paid, and the 500 would be expense. Okay, what of company B? How much would we show in the books, in the income statement? Josiah Abdul Somed. Josiah.
Yeah, madam. Hello.
Yes.
Can you hear me?
Josiah, we can hear
okay.
you. Yes, I can hear you.
Madam, please, the rent is 3,000, but they paid 3,100. So it means that so we are recording 3,000 in the income statement. And then
if we have paid 3,100,
so the difference is a prepaid expense, which is yet to be used.
Okay, so the difference of how much?
That's 100 cedis. The difference of 100
okay,
cedis.
So good. So the difference of 100 cedis, okay, will be regarded as what?
That's a current asset. Prepaid
current
expense.
asset. It is a prepaid expense. Okay, so we are paying. So we have paid 3,100, but we have only enjoyed the rent for the year to the tune of 3,000. The 100 cedis we have paid in advance. So it is a prepaid, okay, asset, current asset. Okay, it's a payment in advance, and that money in the hands of the landlord belongs to us technically. Okay, and so that is it. Now let's look at this as well. Somebody read for us.
Income example. The company rents its building to two other entities at 2,000 Ghana cedis a year. Company X pays 1,700 Ghana cedis in the year. Company Y pays 2,500 Ghana cedis in the year. How much is recognized in the income statement as rent income for the year? Madam, please finish.
The first one for us. Amabel. Okay, so let's see. Yanya kwa. Enoch appear Japan. Are these people in the class? Are these people in the class?
Yes, madam.
Okay, who help us out? We'll go along with those who go. Yes, Patrick Forson.
Madam, please, 2,000. Madam, please, 2,000 be recognized in the income statement.
2,000 cedis will be recognized in the income statement. So for company X, what will happen?
Madam, please.
Yes, Johnson.
Okay, madam. So the difference of for company S, the difference of 300 would be accrued income. So it will reflect in the balance sheet, please.
Yes, under what? Because yes,
okay,
it may reflect there, but under what?
Under current asset, please.
Why it reflects under current assets?
Because company S owes the business, so it is supposed to pay the business the amount of 300. Yes, so accrued income has been earned, but then it has not. It is yet to be paid for. So definitely, the company S will have to pay the business. So we recognize it as an asset, please.
Okay, so company X, remember that the business has rented out the building to two entities, and they're supposed to pay 2,000 cedis a year. Now, company X has only paid 1,700, and 300 it is an asset to our business because company X is yet to pay. So it should be an asset. Anything the business owns or any resources that the business controls. Company Y, Saki, your hand is up. Complete it for us quickly.
Madam, please, 2,000 will be recognized in the income statement. Then the difference of 500 will be a liability because they paid us in advance. So it's a liability to the company. So it will be under current liabilities in the balance sheet.
Okay, so good. So again, our amount for the income statement should be 2,000. So that is how much we recognize in the income statement. But we realize that when you buy And so that amount, that difference of 500 for this year, we cannot say we have earned it. And so it belongs to company Y. Okay, and so we treat all third-party amounts as liabilities, and that 500 is a current liability. Now, in summary, this is what we have been doing. And so if you have information, okay, about these expenses, okay, cash paid for the period. So sometimes in the information, you have some, or when they are giving you a question, you have information on the cash paid in respect of the expense, as we have just seen, accruals in the last year. Remember, if an expense accrued in the last year, it means that it was owing last year. Okay, and so we must, what belongs to this year, the owing is what we owe for this particular year. Okay, then we add what we have paid, expenses that we have paid more than we should have paid last year. Now, why for 2020? It means what we paid more reflects again, we have paid more against next year because that amount of prepayment comes to the period next year. And so every time we want to determine the expenses for the period for which we are preparing financials, we can use this. Don't get worried. All you need to understand, if you understand it per what we did, you can go by it. If you have information for all these, all you need to do is to slot in the figures. If there is no information, it is 0, 0. For instance, we are preparing for 2021. In 2021, we have paid a certain amount, 10,000, okay, for maybe some insurance figure. But last year, we had owings that we didn't pay. Because it belongs to last year, remember we are interested in what year matching. So at every point in time, we are interested in have we incurred, not paid for the year. Okay, so we are interested in how much we have incurred, not what we have paid. We can incur and not necessarily pay. Okay, paid will not represent, will not never be equal to how much we have incurred if we have information on all these. If we don't have any other information, we can assume that the cash paid is equal to the expense incurred. But if we have additional information, which of course we haven't, after learning this, then we must determine the owings for last year and take it out because 2021, not 2020. December has come. We still have not yet paid. We add it. And then for the prepayments for last year, the amounts we overpaid belongs to this year. We add it to the cash. And then we take out amounts that we have overpaid that belongs to next year to arrive at our expenses incurred for this period. Okay, similarly, for the income, we have to look at how much we have received. Okay, remember, we are interested in income earned for the period. Income earned for the period. And so the cash amount we have received may not necessarily be what we have earned. Okay, and so what amount we receive, we will take out what we accrued for last year, because that we are interested in this year, not last year. And then we will add what belongs to this year. Again, add prepayments in last year. Okay, because last year when we prepaid, it belongs to this year. So we'll add it to this year's figure. And then take out income that belongs to next year that we have received. Okay, prepayments that we have received in this year that belongs to next year. This prepayment, it means it's payment more than the income that we have earned for the period. Now, in the financials, there are other things that we could consider. I'm sure for some of them would have already seen them. Goods drawings by the owner, the use of all these, any transaction that relates to the owner must be recognized against the owner's capital. Okay. Sometimes the owner's private expense that has been charged against the business. When we get to capital account, we'll have to move all into the capital account against the owner's capital. Okay. And that brings us to the end of this lecture. I sent a question to you this morning. Who has the question quickly? I have another class. Ben, is the class coming on at 8:30? Ben, will the other group come on?
They joined this class, and I'm also recording it.
So there'll be no class after this?
Yes, so we agreed that I'll send them the recording.
Okay, you have saved me. Thank you very much.
You're welcome.
Okay. So let's go through the question. Then I guess we should be able to complete at least one question on that, so that can be circulated. Okay, so that is the question. Okay. Question 1, this morning we realized it was pretty straightforward. So we have receivables, 31st December balance. Okay, for January, we have December 2016, December 2017. Then we have the provisions for doubtful debts. And we have provision for cash discounts. You are required to show the above information for the year ended 31st December 2015, 16, 17 in the following books, the following accounts: provision for doubtful debts. So what balance has provision for doubtful debts? What balance?
It has credit balance.
It has a credit balance. So 31st December, it has a credit balance of 110,000. Okay. Now, provision for cash discounts on receivables. The question is, how are you going to compute it? Okay, it says 15%. 15% On what? What will you be calculating cash discount on? On
receivables.
Receivables.
On receivables. Okay, on receivables. So in this instance,
receivables.
Okay, thank you. The provisions are just amounts that are set aside just to attract people to pay in good time. And that is why you have 15%, okay, provision for cash discount. And so once it's a provision, what balance will it have? What balance will it have?
Credit.
That's credit balance.
Credit
It will
balance.
also have a credit balance.
Credit balance.
Okay. So all you need to know is to open the accounts. What balance has receivables?
Debit balance.
Debit balance.
So 31st December, you debit receivables 200,000. You credit provisions
Being balance.
for doubtful debts with 110. You compute your provision for cash discount amount. Okay. And then you can deduce your, so that is what you do. 2016, you add on, so, and then so for 31st December, the 200,000, where will you find it? How will you treat it in the income statement? What value will go to the income statement? I have to stop if I have to. What value will go to the income statement? Yes. Hey, nobody will talk. Evenings, we are very tired. So please contribute and quickly do that. Okay. So we have the receivables.
Madam, 30,000.
We have the provision for doubtful debts. Account. Okay. So this is 31st what? 31st, 12, 15. Balance brought down or brought forward. How much was it?
200,000.
200,000. Same thing here. 31st December 2015. And brought down. How much is it?
110,000 cedis.
110,000. So if we were to open the financial statement extract, so it says we should draw and the statement of financial position. So let's see, income statement extract. When we say extract, it means that we have only pulled out some figure. It's not a full-blown one. Okay. So what are some of the things that will go into income statement? We don't have the full one, so I just put the things as it is, but that doesn't mean they are the first ones. So if we had done depreciation, our depreciation expense would have our depreciation expense would have come here with it. Okay. Then today, what do we have? Provision for what? Bad what?
Bad debt.
Okay, so we have the provision for bad debts. We could have others, rent expense. So I'm just putting all the possible things that we can find in the expenditure column of the income statement. If we open our statement of financial position, statement of financial position extract. We will have that machinery. If you recall last week, we did machinery accounts at cost or at net book value, depending on which one, at cost or net book value, NBV, depending on which one is applicable. And then we'll have a less depreciation. Less how much is our receivables figure? I'll stop working. After this, we go and complete. Hello?
Yes,
Hey, so
madam.
Hi.
Madam.
Hi, madam.
Hi.
I didn't realize I had muted myself and I was just talking.
Oh.
Oh, sorry,
Oh.
madam. Sorry, madam.
And I was
Sorry.
Provision for doubtful debts.
$110,000 cedis.
110,000. Okay. If we were doing the income statement abstract, okay, so what I was saying is we're doing the income statement, so had other things. So last week we talked about depreciation. So we would have had the depreciation expense here. Depreciation expense figure here. We just talked about provision for debts for the period would also have come in here if we had okay, accrued income. Accrued income will go into the statement of financial position. So we can couple of okay, so let's take receivables. 10,000 debit, sales debit 100, that gives us 110, less 91 what? 900. How much does it give us? 110,000 minus 91,900. $18,100. Good. Now read this statement. So what is our provision for doubtful debts? What will be our provision for doubtful debts? Disturbing us. Who is disturbing us? Yes, I know. If it was movies, everybody would have watched. But everybody is tired and feeling sleepy. I'm even more tired than you are. 1st January. 1/1/15. Balance brought forward. How much was the balance brought forward?
10,000.
10,000 in the course of 2015. Sales, how much was the sales?
100,000.
100,000. We have returns. Sales returns. How much was the returns?
1,000.
1,000. What else? Receipts from customers. How much was that?
90,000.
What else?
Bad debt written off.
How much?
500.
What else?
Discount allowed.
How much was the discount?
400.
Any other?
No.
What is our balance?
Where you going?
Okay, so in computing our provision for doubtful debts, what does the statement say? %5 of what?
5% of receivables after making a specific provision for a debt of
5%. So what is our closing receivables if the figure is correct? After making what?
After making a specific provision for a debt of 200 from a customer.
Ah, gosh. That's a specific debt. So what is our provision? What is our, how much?
705.
705. And that is for the year ended 20 what? 15. Now, if we were continuing this for 2016, okay, we know our balance BF will be 18,100. Do we have sales for 2016?
Yes, 100,000.
So 1st January 16, balance BF Then sales for 2016. So we can put 2016 sales. How much is it?
100,000.
2016 sales is 200.
Yes, please.
Any sales discount? Any
500.
discount?
500.
500. What else?
Bad debts.
Madam.
1,500.
Yes.
Madam, it said 90% of the sales are on credit. So we have to find.
So when you give,
yeah.
yes. So if you don't tell me, and we allow one person, so how many of them are on credit? So you see, you must be very careful. These are some of the things that occur in exams, and the student will say, "As for this paper, I've massacred it." Meanwhile, you haven't massacred anything. So be very, very careful as you go about it. So how much would that be?
90,000. 90,000.
I can't look at the question because I'm writing 90,000. What else? Excuse me. So we have discount here. Discount allowed. How much is the discount allowed?
500.
500. What else? I'm
Bad
sure there'll
debt.
be receipts from customer. Bad debts. How much?
1,500.
1,500. What else?
Receipts from customers.
95,000.
95,000. What else? Are we done?
Sales returns 90% relating to credit customers.
Sales returns 90% relating to credit customers. So 90% relating to credit customers, and they were 90,000. So how much would that be?
$81,000.
Is it 81 or 81?
It's 81,000.
It's 81,000.
It's 81,000.
Yeah, but I'm written.
Yes, madam.
8,100.
You see? Look at, they've put the value there, 2,000, and you're talking about 90% relating to credit customers. So it's because they have already, you see, they've given the earlier one 90% on credit. So the sales returns is relating to that 90% based to the credit customers. This is based on, you understand? But they've given you the amount. So why would we do 81,000? So it cannot all be done in one account. It cannot all be, so it's 2,000, okay. Sales returns, so you see how you can easily get lost. Sales returns is 2,000. What else? Are we done?
Receivable balances settled by contract against creditor balances.
So what do we do? In the contract, this thing doesn't come in. So contract. How much is it? Who doesn't want to join and is disturbing us? So what is, if there is nothing else? Sorry, this one had to be here. What is our balance carried down? And nobody will give me balance carried down. People.
$7,900.
How much?
7,900.
Okay, so you would realize that our provisions for 2015 was 705. If we were opening the provisions account, okay, do we have an opening balance? Do we have an opening balance?
Yes, we have 400.
Yes, please. 400 cedis.
400 cedis. Okay, for 2015, provision was 705. So 2016, we have to compute. Now, what does it say about the 2016 computation for provision?
At the end of 2016, the provision for doubtful debt is still required to be 5% of receivables.
So provision 5%. %5 of what? What is our receivables figure? What was our receivables figure?
100,000. 90% on credit.
Are you sure?
7,900.
Yes, 7,900. That is our closing balance. So that is our new receivables figure. So how much is our provision? Mm-hmm.
395.
395. We have a decrease in provision or we have an increase in provision? What do we have?
Decrease.
A decrease in provision. Okay, and anytime we have a decrease in provision, so you recall that for 2015, the provision here, in fact, we should have put income statement here. Okay, provision into bracket, income statement. Okay, and when we go back to income statement, oh, I didn't add, it went off, the income statement went off. So now we have a decrease in provision. Is it an expense or income?
An income.
An income. So if we were crediting income statement, well, where would we put the double entry?
We debit provision for doubtful debt.
We debit provision for doubtful
income statement.
debt. With how much? With how much?
395.
95.
Are you sure?
No,
Are
you
you sure?
subtract the
Solomon, yes.
705 from the 395.
Exactly, and that is what I was telling you. The difference in provision represents the increase or decrease. So the difference in provision here would be the current from the old. Okay, so 395 minus 705, giving us what?
310, please.
Giving us a negative of
Negative.
310. And so it is the 310 that will bring here. So assuming, somebody is making noise, please let me wind up. I'm tired myself. I just wanted to make this point clear. That is why I'm doing this. Otherwise, I would have closed this class long time. So the issue is that at the end of 2016, the provision in the account should be 395. You see, even with the 405, we did not do it. We should have determined the 405. But you didn't say it. You didn't say it. So I didn't see you raise up your hand. Sorry. So the 2015 provision, actually, because there was a balance, okay, so the 2015 itself is wrong. When I don't have because I didn't know there was a balance for provision. Okay, so it should have been the 705. 705 minus what?
Minus 400. 400.
Minus 400. Okay, to give us 305. So the 2015 should have actually been 305. So it means we have to check it. We would have to correct all. So that should be 305. It's very important. Once you have an existing provision, you must always compare. So it means that what we have put here, the 395, this figure here is also wrong. So it should be 395. So the difference actually okay, so let me take that again. So the difference in provision is equal to I thought I'd put the 305 here. 305. Now, if you look at it, the previous one, so as at 2015, the total provision was 705. So the old one plus the current one gives us the 705. Now, in 2016, okay, what did we have? 395. Okay, so 395, that's my thing, right? So as at 2015, it is 395 minus what? 705. It still comes back to 705. to give us what? 310. So at the end of 2016, our provisions balance should be 395. Check whether we'll balance. Balance CD. If that is the only thing. This is 705 minus 310 to give us 395. So provisions are every year, whatever you calculate is the total. So you check it against the previous to give you the difference. So it's the difference you send to income statement. Okay, and that amount that you calculate for the year becomes your yearly provision, total provision figure. Okay, so for this one, we're right. I think the challenge was just the 2015. The 2015. Any question? I think it's been in a rush and everybody is stressed out this evening. So God willing, on Thursday, we would have our full and normal class. Hoping we are all okay and good. But I'll send the question to you, Roseanne and Ben, shortly. So on Thursday, we should have enough time on Friday and Thursday to compute or to run through a full-blown question. Any question? Any question?
No, please have a question.
Okay. Yes, somebody is reminding me Thursday is a holiday. For our brothers and sisters, so what do we do? Because if we don't have it on Thursday, then that throws us to Tuesday, even Tuesday.
Madam, let's still meet.